Hello and welcome to Value Research Podcast. You're listening to First Page, a column written by Dhirendra Kumar. Perspective in a panic. Market dips hurt, but history offers comfort. A glance at social media these days would make you think the financial apocalypse had arrived. My inbox is flooded with messages from distressed investors lamenting their destroyed portfolios. The anguish is palpable, but a bit of perspective might be the best medicine. Let's consider what's happening right now as I write this. The 6-month picture reveals genuine pain. The BSE Sensex has plummeted 11.5%, shedding more than 9,400 points. Small caps carnage is even more pronounced, with a staggering 23.7% collapse, erasing over 13,200 points. These aren't minor corrections. They represent real wealth vanishing from portfolios. This certainly feels devastating for investors who are heavily weighed towards smaller companies, especially those who joined the market recently. I understand that anguish, watching months or years of gains evaporate in weeks, is genuinely distressing, regardless of what historical patterns might suggest. But here's where perspective becomes invaluable. Look at the 5-year charts and suddenly the story transforms dramatically. The Sensex has gained an impressive 95% over this period, while small caps have surged by a remarkable 221%. Even after this crash, patient investors who stayed the course for 5 years have seen their investments multiply substantially. This pattern isn't new or surprising, though the severity might feel unprecedented to newer investors. The 6-month charts reveal what experienced market participants recognize as a classic correction: sharp, painful, and seemingly relentless. Yet, market historians will tell you that downturns of this magnitude occur with almost clockwork regularity. They're the natural breathing rhythm of a healthy market, though they rarely feel healthy while we're enduring them. The trouble begins when we forget this fundamental truth and position our portfolios as if markets only move in one direction. I've long advocated for a balanced approach, loosely speaking, perhaps 10 to 30% in fixed income, 30 to 40% in large caps, and the remainder divided among mid and small caps. This isn't merely conservative prudence, it's recognition of market reality. For investors who structured their portfolios this way, the current situation is manageable. Uncomfortable perhaps, but not devastating. If you find yourself among those feeling crushed by recent market movements, I won't offer the cold comfort of "I told you so." We've all made investment mistakes, myself included. The question isn't whether we will, but whether we'll learn from the experience. Think of market downturns as fee payments in your financial education. The lessons may be expensive, but they're valuable if properly absorbed. The key insight isn't that markets sometimes fall. Everyone knows this intellectually. The profound lesson is that knowing this fact doesn't immunize us against emotional reactions when it happens. If you're feeling the sting right now, consider using this experience to reassess your true risk tolerance. It's easy to embrace risk when markets are soaring. During downturns, we discover our capacity for volatility. Perhaps your allocation needs adjustment, not because markets are unpredictable, but because your emotional response to them proved more intense than anticipated. Remember that time remains the most powerful tool in any investor's arsenal. The 5-year charts don't merely show impressive gains. They reveal the reward for patience during previous downturns that have been entirely forgotten. The investors who achieved those returns weren't necessarily more brilliant than others. They were more disciplined about staying invested. Even this severe 6-month plunge, while uncomfortable for properly diversified investors, is manageable within a broader investment strategy. While the small cap investor who's watched half of the portfolio value evaporate might suffer acutely, the balanced investor who maintained significant large cap and fixed income positions is experiencing something much less catastrophic. This stark contrast is precisely why diversification matters, not as an abstract principle, but as practical protection against market trauma. The current correction also provides a vital reminder about market timing. Many investors who entered during the exuberant bull run never truly internalized how quickly sentiment can shift. 6 months ago, the market seemed unstoppable. Today, despair abounds. Neither extreme accurately reflects fundamental economic realities. They are simply the emotional pendulum of market psychology, swinging from one extreme to another. For those who find themselves overexposed to the current volatility, remember that hasty decisions during periods of maximum pain rarely serve long-term interests. Markets will recover as they always have. The question isn't whether they'll bounce back, but whether we'll have the wisdom and discipline to be positioned appropriately when they do. And perhaps most importantly, whether we'll remember this lesson the next time markets are soaring and caution seems unnecessary.